The year is 1953. The air in the office is thick with the smell of floor wax and stale coffee. Walt Disney sits across from a mahogany desk, his hands clasped tightly. He has been here before, in different cities, in different offices, presenting the same dream. The man behind the desk does not look up. He simply shakes his head, slides a folder across the polished wood, and signals for the next appointment. Another bank, another refusal. Disney walks out into the blinding afternoon heat, the rejection echoing in his ears like a closing vault door. Every major institution in America has turned him away. They see his vision as a gamble, a fantasy built on nothing. He stands on the sidewalk, watching the city move around him, realizing the traditional path is dead. There is no funding, there is no backing. The dreams he has spent years drafting are sitting in his briefcase, completely worthless to the world. He starts to walk, his stride quickening as the weight of the situation settles in. He has run out of options. He has run out of time. He is entirely on his own. Disney did not go home to give up. He went to his study, pulled out his insurance files, and looked at the numbers. The banks wanted control, so he took the power back. He signed the papers, leveraging his own life insurance policy to secure the capital the banks refused to provide. It was a calculated, high-stakes maneuver that left the financial institutions stunned. The cash flowed into his project. Work began. 6 months later, the gates of Disneyland opened to a world that said it could never happen. That single act of self-funding created a $200 billion empire. It proved that the system was rigged, but also that there was a way to break it. This mechanism has a name: infinite banking. It is the strategy of becoming your own source of credit. Disney had found the secret door. He had built his own bank, using a tool that the financial elite have spent 70 years trying to keep hidden from the public eye. The gamble paid off, not just in park tickets, but in a fundamental shift of financial power. While Disney built an empire by keeping the interest, you are currently financing the empires of others. Look at your own pay stub. For every dollar you earn, 34 cents flows directly to interest payments before you ever see a profit. It is a hidden tax on your labor. You deposit money into a local branch, and they immediately lend those same funds out multiple times over. Every time you swipe a card for a mortgage, a car loan, or a credit line, you are paying the spread. The math is relentless. Over the course of a standard working lifetime, the typical household hands over more than $1 million in interest to financial institutions. You are not just spending money. You are renting your own life while the banking system builds its wealth on your back. You work for the dollar, but the dollar works for them. They have turned your paycheck into their perpetual revenue stream. You are financing their growth, their skyscrapers, and their dividends, while your own net worth remains stagnant. This is not a coincidence. It is the design. You are trapped in a cycle of debt that keeps the machine running, and the machine relies entirely on you never noticing where the money actually goes. The financial gurus are loud. They appear on television and write columns telling you that whole life insurance is a waste of capital. They call it garbage. They urge you to stay away. Yet, if you look behind the heavy doors of the major banking institutions, you find a different story entirely. Banks currently park over $190 billion of their safest assets into BOLI, or bank-owned life insurance. The very product they mock in public, they hoard in private. Consider the logistics. Why would a bank bet its own money on an instrument it tells you to avoid? They are not losing money. They are securing it. They treat these policies as the foundation of their own balance sheets, earning tax-advantaged growth while you are steered toward products that keep you dependent on their lending cycles. The hypocrisy is not accidental. It is a strategic wall built to keep you from the same tools they use to ensure their own survival. You are being fed a narrative that protects their profit margins. They want you to believe the tool is broken, because if you realized it worked, you would stop paying them interest and start building your own private reservoir of wealth instead. The solution to this systemic trap arrived in the form of a book that changed the financial trajectory for thousands. R. Nelson Nash wrote, "Becoming Your Own Banker to Dismantle the Dependence on Institutional Lending." He identified a specific mechanism that allows you to bypass the bank entirely. It is not just any insurance policy. The tool must be a properly structured, dividend-paying whole-life policy issued by a mutual company. This is the bedrock. A mutual company is owned by its policyholders, not by public shareholders, which means the profits return to you. The policy must be deliberately overfunded with high paid-up additions. This is not a savings account. It is a private banking system. By design, it builds guaranteed cash value that grows every year, independent of the volatility found in the stock market. You are not buying a death benefit. You are acquiring a financial engine. Nash proved that when you control the policy, you control the capital. You stop acting as a borrower for the bank and start acting as the lender for your own life. It requires moving away from the standard products pushed by salespeople and toward a precision-engineered financial instrument that functions exactly as the banks have been using for decades. Consider the reality of your current financial environment. Every time the stock market dips, your portfolio value reflects that loss. You watch the numbers on your screen fluctuate, and you feel the weight of that uncertainty. The infinite banking strategy replaces that gamble with a mathematical guarantee. Within a properly structured, dividend-paying whole-life policy, your cash value does not follow the index. It grows steadily, year after year, regardless of external economic conditions. This is the definition of a safe haven. The growth is contractual. The insurance company commits to a minimum rate, and the dividends add another layer of potential gain. Because the policy is tax-advantaged, you are not losing a significant portion of your growth to the government every time the value shifts. You watch your cash balance increase on every statement, without the fear of a market correction wiping out years of progress. You stop checking the news to see if your money is safe. You know it is. This is not just about hoarding cash. It is about building a foundation that stays upright when the rest of the economy shakes. You gain the ability to plan your financial life with precision, knowing exactly what your capital base will look like next year and the year after that. Now, we reach the point where the strategy shifts from passive accumulation to active control. You have built your cash value, but leaving it stagnant is not the goal. You must learn the mechanism of the loan. When you need capital for a major purchase, you do not withdraw your funds. Withdrawing is a mistake that stops your compounding growth. Instead, you borrow against your cash value. The insurance company provides the loan using your policy as collateral. This is the moment the dynamic changes. You are no longer taking money out of your own pocket. You are leveraging your asset to access liquidity. However, this is where the complexity begins to bite. This is the reason 9 out of 10 people who attempt this strategy fail. They treat the loan like a bank withdrawal or an ordinary line of credit. They miss the requirement of structured repayment and the precise alignment of the policy design. If you fail to understand how these loans interact with your death benefit, or if you treat the capital as free money, you will erode the very foundation you built. The system is precise, and it demands a level of discipline that most are not trained to apply. One wrong move in this phase turns a wealth-building tool into a liability. Let us strip away the mystery and look at the engine of this system. Your money earns in 2 places at once. Imagine you have $100,000 in cash value. You need $50,000 for a vehicle. You do not withdraw, you borrow. The insurance company grants you the loan, using your policy as the anchor. Here is the magic. Your entire $100,000 balance continues to compound at 5% as if you never touched a single cent.
You are earning growth on money you have already deployed elsewhere. That is the leverage. Now,
consider the repayment. When you take a loan from a bank, you pay interest that vanishes into their ledger.
Here, you pay that interest back into your own policy. You are the borrower.
And you are the banker. You recycle the capital. You recapture the interest that would have otherwise funded someone else's empire. This is the mechanism that turns a simple insurance policy into a private banking system.
You stop financing the bank's wealth and start financing your own.
You are no longer just a customer in the system. You have become the owner of the system. Success in this system is not guaranteed by the mere existence of a policy. It is defined by how you manage it.
9 out of 10 people who attempt infinite banking fail. They start with enthusiasm,
but they trip over a single, devastating detail. They misunderstand the structural backbone of the product. They treat it as a flexible savings account rather than a precisely engineered financial instrument. If you fail to design the policy with high paid-up additions and a low base premium, you are burying your capital in front-loaded costs. You are essentially paying for the engine but never turning the key. This is not a casual endeavor. If you treat this like a standard savings plan, you will lose money in the early years. The math is unforgiving. If you do not have an agent who understands the specific mechanics of dividend-paying mutual companies, you are flying blind. Many try to force the system to work without the correct blueprint, and they end up with a high-cost burden instead of a wealth-building machine. You must treat the policy structure as the foundation of your future. Miss this one detail, and the entire system collapses into a costly mistake. When you stop paying interest to a bank, you stop feeding their growth. Think about the scale.
For decades, you have been the fuel for their dividends. Now, the cycle reverses.
Every dollar of interest you pay back to your policy is a dollar that stays within your control. You are not just saving money. You are capturing the cost of your own life. This is the moment the dynamic shifts. You are no longer borrowing from a stranger who dictates your terms. You are utilizing your own capitalized assets to fund your future. It is a quiet transition, but it is absolute. When you look at your balance, you see your own hard work compounding, not a bank's profit margin. You are effectively reclaiming the interest you would have handed over for your home, your car, and your business. By controlling the financing, you control the outcome. You have moved from being a renter of your own financial life to the owner of your own banking system. The elite have used this leverage for generations. Now, the mechanism is in your hands. You have finally stepped outside the system that relies on your debt to survive, and you have started building the private empire that the banks never wanted you to access. Let us be clear about the risks. This is not a get-rich-quick scheme. It is a long game. Policy loans carry interest. If you borrow against your cash value and fail to pay yourself back, you erode your death benefit. You are eating into your future inheritance. Furthermore, the early years are deceptive. Costs are front-loaded. You will not see massive growth in month 1 or even year 2. It takes 7 to 10 years of consistent, deliberate action for the policy to hit its full power. This requires discipline. It requires a long-term view. Most people quit when they do not see instant results, and that is exactly why they stay trapped in the traditional banking cycle. You must commit to the structure, pay your premiums on time, and manage your loans with the same rigor you would expect from a professional lender. If you are looking for a shortcut, this is not it. But if you are looking for a proven path to certainty, you must be willing to put in the time. The transition from debt slave to bank owner is not a sprint, it is a marathon. You are building a system that lasts for generations, and that foundation takes time to set. When the marathon ends, the true power of this system reveals itself. You have spent decades recapturing interest, building capital, and managing your own financial flow. Now, that work bears its final fruit. When you pass, a tax-free death benefit transfers to your heirs. It is not just a sum of money. It is a private banking system, fully funded and ready for the next generation to inherit. Your children do not start at zero. They start with the foundation you built. They receive the tools to finance their own lives without bowing to institutional debt. You have handed them a legacy that is immune to market crashes and shielded from the reach of traditional lenders. This is what generational wealth looks like. It is the ability to provide certainty in an uncertain world. Your family will not just inherit your assets, they will inherit the mechanism of control. You have transformed a lifetime of interest payments into a permanent, self-sustaining stream of capital. The cycle of debt ends with you. You have secured your family's financial autonomy, ensuring that the empire you built remains in their hands, exactly as it was meant to be, for decades to come. If you are finished handing your hard-earned money to institutions that profit from your debt, then you are ready to take control. You are ready to build the system they keep hidden behind closed doors. But knowing the concept is only half the battle. The real power lies in the structure. Next week, I am pulling back the curtain on the exact policy blueprint the wealthy use to protect their capital. I will show you the real numbers. You will see the specific ratios for paid-up additions, the right types of mutual companies, and the mechanical setup that makes this strategy function for everyday people. This is the technical roadmap that turns theory into a verifiable financial engine. You will not find this blueprint anywhere else. It is not just about understanding the philosophy. It is about executing the math. Do not let another month go by financing someone else's empire. Hit the subscribe button now and turn on notifications. When that video drops, you will have the final pieces of the puzzle. You will have the blueprint to stop renting your life and start owning your future. See you next week.